Okay, well, do a quick review. So again, we are learning about budgeting this week. And we've learned different approaches to budgeting, right? The executives telling everybody what the budget is, or bottom up would be getting input as to what the lower levels think their budget should be. We talked about traditional versus zero-based. What was the difference between these two approaches? Traditional versus zero-based budgeting. Yep. Zero-based budget, you start from zero. You have to justify every cost that you're estimating. Whereas the traditional method is you base your budget on what? Previous period, exactly. Okay, and flexible versus static budgets. Make sure you put your name there on the list. So the difference there being with a flexible budget, you actually adjust your costs based on what? Based on your actual sales. So you look at what your actual sales are, and then adjust what your budgeted costs should be. And then you can compare your actual costs with the budgeted costs, right? But if you use a static budget, you don't make any adjustments. So it's a little harder to see what your cost should be since your sales might be completely different than what you had planned for. Okay, then we talk about rolling budgets where you just continually keep extending it so you always have at least 1 year of budgeting planned. We saw the master budget. And the first section is the operating budgets, and the second section is the financial budgets, right? And you basically start at the top and work your way through. Then we went through a bunch of examples, so we're not going to relive that. Okay, so when we get into the financial budget, we need to have a capital budget for any major purchases of assets, long-term assets. Because that really has to be handled separately from our normal cash budget, right? Because we might need to finance by taking out loans. We might need to do equity financing where we issue stock. And once we figure out how we're going to finance our capital assets, that then will tell us what kind of interest we'll be paying or what kind of dividends we might be expecting to pay on the new stock that we issued. So that all feeds back into the cash budget. Right. Okay, and we worked on the cash collection schedule where you figure out how much you're going to collect from your customers who owe you money. And we also did the cash payment schedule where you figure out how much you're going to pay the suppliers that you owe money to, right? We went through this example of the cash budget to see at what points the company was going to be low on cash. And in this particular case, they were able to borrow money in those cash crunch periods and then pay it back when they had extra cash. So we've seen budgeted income statements, budgeted balance sheets, pretty much like any normal income statements and balance sheets. It's just that they're based on projected data. I already talked about that. Let's see where we're at here. Okay, yeah, that's as far as we got. Right there. Yeah, I don't think we covered this slide. So as you see, we have only a few slides left. All right, so let's think about this one here. You're beginning your own business, and for the first couple months, okay, for the first couple months, things are going pretty well from a cash flow standpoint. But then in the third month, the cash collected and the cash paid differ significantly from the budget. Now, it doesn't say is it differing in a bad way or a good way, so we don't necessarily know. But let's just think about how it could differ. Cash collected comes from where? Yeah, revenue that hasn't been paid for yet, and then now your customers are paying you, right? So anytime you make a sale, you either get paid right away or you get paid later, or you don't get paid at all and you have a bad debt. So it could be that we're either collecting more than we anticipated or less than we anticipated. Okay, but it also says that cash paid is differing significantly from the budget. That means we might be paying out more than we planned or less than we planned. Right? Because we can estimate those things, but sometimes things come up. You might have an emergency expense that you have to pay for right away. You might find out that something you thought you had to pay for, you've got more time, or it's actually cheaper than you thought. You might have customers that pay you sooner than you thought, or that don't pay you at all. So all of those things can impact a company's cash flow. So what could we do? Let's say that these were negative impacts. Let's say everything's going fine for 2 months, and then all of a sudden, our customers aren't paying us as quickly as we want, and we find we're spending more money than we had planned. What's the potential problem there? The money's not coming in very fast, and it's going out too fast. We run out of money, right? So what could we do? Okay. Like what are you thinking? Like for the budget on the money that's coming in? Mm-hmm. Well, so if we can find a way to sell more products and generate more cash, that could work. But then we need to produce those products. We need more material, more labor. So that could also increase our costs temporarily. What else could we do? Like more immediate? How can we get more money in faster and stop the outflow of money, or at least slow it down? What are some immediate things we might do?
Can you get a loan?
Okay, go out and borrow a loan, and that if we get approved for the loan, the money comes right in, right? So that could generate some money.
Sell shares or
Sell shares, true, equity. Would be a great way to finance. We also call up our customers and say, hey, where's that money you owe us? We're not going to sell you any more product. In fact, we're going to sue you if you don't pay us, right? You can take different actions to try to get that money in from those customers. What about the outgoing money? You have control of that, right? You could not pay your suppliers. They're not going to like that. They might call you. They might sue you, right? But you have control over whether or not you make that payment. And sometimes companies have to delay payment because they just don't have the cash. I would say if your choice is paying your suppliers or paying your employees, pay your employees. Because they'll take you to the labor department in a heartbeat, right? It's really bad news if you're not paying your employees. And especially morale is going to decline, right? Even if they stay working for you, they're not going to be very happy. Make sure you got enough cash to pay your employees. I've been in a situation before back when I worked for this .com company, and we started to have cash flow problems. I had 20 people at one point in my department, and I remember the CEO coming to me and saying, we're going to give the employees their paychecks today, but ask them not to cash them until Monday. Man, that's a hard thing to ask employees. And there were cases where some of their paychecks bounced because the company didn't have enough money. That was a really bad situation to be in. So if you have to, you're having cash flow issues, you want to try to get your customers to pay you faster because they already owe you the money, right? And then try to slow down any cash payments. Obviously, you've got to pay your taxes, you have to pay your employees. There's some things you really don't want to put off. But it's very common for companies to delay paying their suppliers. What's likely to happen? The supplier might say, well, you're not going to get a discount. And guess what? In the future, we're going to require that you pay cash instead of giving you credit terms. Or we're just not going to sell to you at all. Or we're going to report this on your credit. But, you know, sometimes that's what companies do. They're willing to take that hit because they, you know, they're just out of cash. But ideally, if you budgeted properly, you don't end up in that situation at all, right? You have good credit policies, so you decide which customers you can extend credit to and which ones not to. And you do a good job collecting from the ones that owe you. You do a good job of managing your outgoing cash, then hopefully you don't get in that situation at all. All right, so here we have a problem. I think, let me think about this for a second. Yeah, I guess we can go ahead and do this. Let's go ahead and do this problem. And then I think we have an exercise following this one. Okay, so problem number 11, prepare a flexible budgeted income. So I don't even have the problem set open, so let's start with that. All right, chapter 7, problem set. Problem 11. God bless you. Okay. So prepare a flexible budgeted income statement for 120,000 units using the following information, and this is from a static budget for 10,000 units. Okay. So we are going to convert that based on 120,000. So how would we figure out our sales revenue? Okay, we take the sales price times 120,000 units. Thank you, Audrey. That's exactly right. And there's my calculator. Oops, did it again. Okay, 90 times 120,000. $10,800,000 of projected sales revenue. All right. Then we have our cost of goods sold section. First, we have our variable costs like direct material. We see that is $30 per unit. So again, we just multiply that by the number of units, right? 30 times 120,000. 3.6 million in direct material. Labor is $15 per unit. So again, we'll multiply that by the 120,000 and we get 1.8 million. Then we have our variable manufacturing overhead of $13 per unit. Same thing. Multiply that by the number of units. 1,560,000. Then we have our fixed manufacturing overhead. That's a flat amount of 75,000. So when we subtract all those manufacturing costs, well, actually, I'm sorry, when we add all those manufacturing costs, we'll have our cost of goods sold. Did I do that right? Let me double check my calculations. Yeah, got a different answer that time. 7,035,000. Does that look right to you all?
Yes.
Okay, 7,035,000. Okay, so that's our cost of goods sold. How then do we get our gross profit?
Our sales minus our cost.
Exactly. Thank you, Alexandro. Sales minus cost of goods sold. 3,765,000. All right. Then we take our selling and administrative expenses for variable selling and administrative. It says $3 per unit. So again, we have to multiply that by the 120,000 units that we sold. However, fixed is a flat 25,000. So now if we subtract those from gross profit, we will get our income before taxes. 3,380,000. Does that look right to everybody? Okay, good. And then this is back when corporate tax rates could be up to 30%, apparently, which is no longer the case. But that would bring us to 1,014,000 of income taxes. All right, we subtract that and we get our net income. $2,366,000. All right, it's a lot of calculations, but I hope that all made sense. Does anyone have questions on that one? Good, we got the right answer. Okay. So again, this was, all this information came from the static budget. But if we wanted to know, well, what if we actually sold 120,000 units? Not only what would that revenue look like, but what would those expenses look like? Right, and it's not just the manufacturing expenses that are impacted, but remember there was also variable sales and administrative expenses. So that's also going to change based on how many units you sell. So with a flexible budget, we're just adjusting all of our costs based on a different amount of sales. Any questions or comments? All right, well, next we have exercise 17, which we haven't done yet. So let's go ahead and get that one done. Okay. So let's see what we know here. The production cost for a waterproof phone case is $7 per unit. So that's a variable cost, right? The more units, the more our cost is going to be. But then there's a fixed component here. Fixed costs are 23,000. So that portion will stay the same regardless of how many units we produce. The question here is how much is the favorable or unfavorable variance if 5,500 units were produced for $61,000. So units produced, we just learned, is 5,500. And the actual costs are 61,000, right? We were just given that information. So let's figure out the rest. Fixed is pretty easy. They told us the fixed costs are 23,000. But what would be our production costs if we produced 5,500 units?
30,500.
Yes. How'd you get that, Robert?
Multiply 5,500 by $7 per unit.
Exactly. So we just take the cost per unit, multiply by the number of units. So $7 of variable costs times 5,500 units, 38,500. Then we add the fixed costs. We get 61,500. So based on this flexible budget, that's what we had budgeted for that amount of sales. Our actual costs came in at 61,000. So as it says here, that's a favorable variance. Why is it favorable?
Because it's over.
Because I think you mean the right thing. The actual costs were under the budgeted costs, right? Because with costs, you want them to be lower than you had planned. That's favorable. And how much is it different? $500. So we have a favorable variance of $500. All right, any questions? Okay. So we can now summarize what we learned in this chapter. So why do we go through all this process of budgeting? Well, so that we can plan, right? Budgeting helps you figure out how many employees you need, how much material you need, any kind of capital equipment you might need, and it helps you figure out how much cash you're going to need and how much cash you can expect to receive, right? So it's a very involved process, but it's really pretty critical to have a budget. All right. And let's see, a static budget, as we know, does not change based on your actual sales, but a flexible budget does change based on your actual sales. The master budget includes operating budgets and financial budgets, right? Those are the two different sections. The operating budgets, once you've completed them all, you can then make your budgeted income statement because you know your projected sales and your projected costs. With the financial budgets, once you've figured out your cash flow, how to finance your capital assets, you can then make your budgeted balance sheet, right? And then we know that favorable variances for costs are when they're lower than we planned. What about for revenue? What would be a favorable variance for revenue? It's over, it's higher, it's more than we planned. That would be favorable. Okay, so that's basically it. It is kind of a light chapter in a sense, but we have another exercise and a whole mess of problems to get through. So I'm going to stop recording here.